Hello, Baker investment students. Hope everybody is having a good weekend. I actually went to Baker University yesterday and watched a little bit of a football game. So I encourage you to take advantage of it if you ever get an opportunity as a student. I know weekends can be busy sometimes, but know that you are students, so you can partake in all those resources that you have as a student, and make sure to take advantage of the library and any other resource when you're in college. But about the past week, I really enjoyed reading about your forum discussion post on the different stocks that you picked. Your professor did not fare so well in his energy strategy, so I measured that I lost $34,745.64, or a 3.47% loss. So I will put that out there as an example. But it just reminded me, John Maynard Keynes, which is a famous British economist. He always had the quote that markets can remain irrational longer than you can remain solvent. So, as we kind of many of you have said, although this is $1 million and it's fictitious, markets swing volatilely. So we'll talk about this week with the idea of standard deviation. But it very well could be that we start a correction during this course in the market. It's done quite well, once COVID hit to now, and there's no guarantees of anything. So that's when you're investing, it's typically for the long run, and many of us are investing for the purpose of the hopes of retiring well someday. So anyway, some things to think about for this week. We're going to continue to repeat what we're doing. So go ahead and whatever day that you chose those stocks, I would suggest kind of doing that on the same day on the weekly basis. I just kind of measured mine, from the Friday to Friday. So whatever day you pick, just post it out there. Tell us what the results were. Post in your forum discussion based on the prompt, and then you'll have your homework that you'll do too. So, but also be thinking about the weeks to come. These time periods are a little bit slower, so start looking ahead to some of those major projects and start working on them now. It'll make your life a lot easier to not have to wait till the end of the course to do them. So just an overview this week. You're going to read chapters 3 and 4. Some of the things I want to highlight from those chapters. Um, Obviously, it talks about investment information, security transactions. When I started with this business back in the early 90s, I remember working with a broker as an internship when I was a senior in college and starting to learn about financial markets. At that time, there wasn't an internet. You had to go through a broker, and obviously you had to do the licensing and all that. And most people didn't invest, or if they invested at all, it was just through their company, and maybe they had a mutual fund or retirement. But with the plethora of information out there, and sometimes it can be quite overwhelming, whether it's the internet or hard print or other sources, or anything you look up, or even if you're going to Baker University library website, you have access to a lot of those resources too. It can be overwhelming. So how do you know what the information is right? Or if you truly believe in efficient markets, any advice that they're giving, probably hope it's more for the long run. But if efficient market hypothesis says that prices should accurately adjust immediately, and you're not going to really have an advantage. But you obviously want to follow a strategy and what's important to you, and also based on that potential risk that you're willing to take on. But some of the things I really like in this chapter, it had a nice review of financial calculators. That's something, what I stress in this course and throughout your program at Baker is I want you to understand the math. Now, you can let the calculators and Excel, and that's why I did a lot of the homework this way, is to help you think about and process this from a formula standpoint. So I think it's really important to understand that, because a lot of stock valuation is all based on present value analysis. It's all about these potential future earnings, future cash flows, the profitability, and we're really discounting back to what is something worth to me today. But that's not guaranteed. Future earnings, future profits, markets change. There can be external factors outside. You're going to read all about these different types of risks: business risk, tax risk, liquidity risk, anything that can impact that company. Politics too. I like to think, going back to that pestle analysis: political, economic, social, technology, legal, the environment. All these factors that are outside the company's control can impact the profitability of that company. So nothing's guaranteed. But the thing I like about the calculators is they're just really quick things you can do to help you, see things, make decisions. But bottom line, we want you to really understand the math behind it. and then you can let the calculators in Excel do all the grunt work for you. You're going to read a little bit about the Dow Jones Industrial Average. You know, I remember when I was in graduate school, they taught us that it was originally like maybe 9 or 10 railroad companies, and actually there were 3 people that were involved in the start of it because the name was too long. They just kept Dow and Jones. But it's just something that's been commonly reported in the news. It doesn't give a wide breadth like the S&P 500 does, but many of your stock picks that you all picked this past week are companies within the Dow Jones Industrial, Apple, McDonald's, Microsoft. So we've always just been interested, but it is just it's an average. It's those 30 stocks divided by a divisor, and the divisor is always changing because sometimes stocks split. So they have to adjust that divisor. Where an index looks at a base year and does comparisons from that base year to the next year. So we're looking at the S&P 500 index. It's always been based on a original year and how that changed from that original year. So you're going to look at the different types of stock brokerage services, whether it's a full service. I often think like a Merrill Lynch. It's someone actually that's wealthy enough to pay someone through, kind of what I call premium discount. Like I use Fidelity for my IRA and other trading, and then a discount one. But today, a lot of financial institutions offer many varieties of different forms of that to try to reach different consumers. You're going to talk about the different types of orders. So the one thing the authors caution you about this: if you do any trading, I worked in financial industry for many years. I used to work in a wire room. I always like to say, before you pull that trigger, make sure it is absolutely right. Is this the right ticker symbol that you have? Are you telling the system to do exactly what you want it to do? So you're going to read about things like a market uh, order, limit orders, buy below a specific price, a stop loss order to sell, and the different nuances of those orders. A lot of individuals use these to try to prevent loss or to take advantage, of a market at a certain time. But you really have to understand them and make sure that it's executed properly. One thing I would say about a market order: you never just want to put a market order in before the day starts, because the bid-ask spread can be a huge difference. So I always encourage people that you want to wait till the market actually opens before you initiate any type of trade for doing that. So. All right, so just a few other things for this week. You're going to read a lot about the idea of return and expected return. You're going to talk about the risk-free rate. We'll talk about that later again with the capital asset pricing model, but essentially a risk-free rate being some real return plus an inflation premium. Now, one of the problems right now is that inflation is increasing quite rapidly. Part of that is because the Federal Reserve, which I'm a little bit concerned about, is been a little bit maybe too easy with monetary policy. I think they should be raising rates now instead of waiting. But there's also the other side, which I understand, is that they want to make sure that the economy is recovered from COVID. But this has also brought about a surge in home prices. If you go out to eat now, you go to the grocery store, prices are going up and up, and that doesn't necessarily mean that our salaries are going up either. So you have a combination of very expansionary monetary policy, expansionary fiscal policy. I'm getting a $250 a month payment for my kid for the child credit. I really don't need it, but these are all examples of just additional spending. So with that, you're going to have inflation. So I'd say one of the criticisms right now of kind of the current administration of the Fed is that they're pushing inflation, and actually what this does, it ends up hurting those individuals at the lower income levels because things just get more expensive. So there are trade-offs. It's a tough situation to deal with, but you don't want inflation to get out of control, because then people can't afford anything. So it's we're going to have to put the brakes on at some point soon. And unfortunately, once you start putting the brakes on, that's when the markets are starting going to adjust too. They're going to recognize this. And some of that might be priced in now, and that's why we probably saw a little bit of a downturn this week too. So it'll be interesting to see what we see through the course. So, but you're going to talk about holding period return. Obviously, the amount you get capital gains or capital losses, or dividends, or you don't receive dividends. So you measure that over a period of time. How did you do with these stocks that you have picked? Obviously, you look at, hey, I bought it at this price, and on paper what it is from X amount of months from now, or in this case 6 weeks. Did I receive any dividends? But you don't actually get the gain. Most of it's on paper until you would actually sell that stock. So you're going to look at internal rate of return again. The idea of internal rate of return is simply it's the rate that sets the net present value back to zero. So kind of give you a little bit of review of finance course. You'll get all these future cash flows and you're discounting it back. So if you had some initial investment and the present value of the cash flows were greater than that initial investment, you had a positive net present value. But what the calculator does and the math does is just say, hey, tell me what that rate of return is so the net present value of my investment is exactly equal to the present value of those cash flows. And that will give us that rate of return. I believe you have a homework problem you can follow in the spreadsheet that you'll need to do with that. The last thing I just want to talk about standard deviation, wrap up for this week. Standard deviation is a great measurement of risk. So how volatile does the stock price change? Like I mentioned in some of your posts this week, the yearly change might have went from like $20 to $80. That's actually a lot of volatility, in that short time period. So it's a risk. But I think they use target in the textbook. But something like a treasury bill is not going to have a lot of risk. The difference between what you get in interest rate, say it's at 3%, might fluctuate from a 4%, down to a 2%. But stock prices can fluctuate widely. It could be go $50 one month and then $70 the next month, or back down to $20 the following month. So when you calculate standard deviation, the first thing you do mathematically is called a variance. So you have to find the average of all those returns. Then you take each one of those observations minus the average, and then you square it, and you keep repeating that. And we use a thing called sigma. You sum up all those, and you divide for a sample variance. You take the number of observations minus 1. If it was the population, you wouldn't take in minus 1, you just take in. But then what you have to do is once you get that variance, and I grew up in the 80s, so I was thinking like Pac-Man, so here's Pac-Man, waka, 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 waka. Well, you take the square root of that variance, because you squared everything, you got to reverse it out. So the standard deviation tells you with, hey, 68% of the time in a normal bell-shaped curve that this stock would, price would, return would fluctuate between this range and this range. And the bigger that fluctuation, the greater the amount of that fluctuation, the greater the risk. So you'll walk through some examples, read through some examples, and practice on your homework. But if you have any questions, do reach out to me. But I hope you have a great week. Good luck with your portfolios. Again, it's always kind of fun to watch that and see what's happened. It's not real money, so that's a good thing. But you all are going to have to make decisions with your money, whether for retirement or saving for your kids' college education or something that you want to do. So that's going to be based on strategy, and ultimately it's up to you to make those decisions. You get advice about it, but you're hopefully going to make the right choices based on your risk tolerance and what your goals and objectives would be. So have a great week. Look forward to talk to you online. Take care.